EU trade deal provides temporary relief, but leaves Europe vulnerable. On July 27 to 28, 2025, US President Donald Trump announced a new framework trade agreement with the European Union that caps tariffs on most EU goods entering the US at 15%. While this represents relief from previously threatened rates of 30%, many European leaders say the deal falls short of expectations. Magnifying glass tilted left key terms of the deal. The 15% tariff floor is now the new baseline on most EU exports, including autos, substantially less punitive than initial threats but far from ideal from the EU's standpoint. A select strategic goods, such as aircraft components, certain chemicals, and agricultural products, may be exempt under a 0-for-0 arrangement, though final details remain incomplete. Chart increasing market and economic reactions. European equities rose sharply on the news, with indices like the STOXX 600 hitting 4-month highs. Investors welcomed the reduction from feared extremes, especially in sectors like auto manufacturing, chemicals, and healthcare. A Jefferies economist Mohit Kumar noted that the 15% rate was better than the market was fearing. Globe showing Europe-Africa political and business responses in Europe. Mixed reactions have emerged across the continent. A Belgian Prime Minister Bart de Wever, quoted on X, called it a moment of relief but not of celebration, highlighting unresolved questions. A European Commission President Ursula von der Leyen described Trump's negotiation style as firm but acknowledged the deal was the best we could get. Germany's Chancellor Friedrich Merz welcomed the deal for averting deeper escalation, but noted it still imposed burdens on Germany's auto-heavy economy. French officials, including European Affairs Minister Benjamin Haddad, criticized the pact as unbalanced and only offering temporary stability. Hungarian Prime Minister Viktor Orbán harshly condemned the agreement, saying the EU has become subordinate to US interests by accepting harsher terms than the UK's deal. Germany's industry lobby BDI called it an inadequate compromise, sending a disastrous signal to European manufacturers. Italy's Giorgia Meloni considered the 15% tariff sustainable and appreciated the stability the deal brings, provided it doesn't compound previous duties. Ireland's Prime Minister Michael Martin welcomed the trade alignment as protective of jobs, while cautioning that higher costs will still challenge exporters. Warning unanswered questions and risks ahead. Several uncertainties remain. It is unclear whether detailed pledges, such as the reported EU commitment to invest in the US or purchase $750 billion in energy, LNG, and nuclear fuel, have binding enforcement and realistic delivery. A US production capacity for LNG is projected to increase but may still fall short of Europe's demand. Oil production projections are also weaker than expected, raising concerns about feasibility. Industries such as automotive, chemicals, pharma, and energy are still uncertain about how revised tariffs or exemptions will affect competitiveness and cross-border supply chains. Pushpin bottom line. The EU trade accord announced in late July 2025 provides short-term relief, notably avoiding worst-case tariff scenarios. Yet many in Europe see it as a strategic setback, a compromise that entrenches higher trade barriers at a time when both political and business communities hoped for 0-for-0 resolutions. Now, the focus is on full details, binding commitments, and how both sides manage long-term investment and energy dependencies. This agreement may be a step away from a trade war, but as many EU stakeholders warn, it is far from the strategic win they initially sought. Let me know if you'd like a sector-specific breakdown or more background on energy and investment aspects. Source acknowledgements. Content is drawn primarily from Reuters, Europe Reactions, and supported by NBC analysis of sector exemptions and tariff specifics.